Hello, everyone. I found this information fascinating when I was researching it, and I wanted to share it. Um, but there are other variables that affect these companies that they recommended. So, whatever you do, do your research first. All right. Well, enjoy. Bye.
Have you ever noticed this incredibly frustrating contradiction? I mean, just think back to like 2020.
Oh, yeah. The massive money printing.
Right. The government and the central bank just printed trillions of dollars out of thin air, and the economy effectively shut down for months, and yet somehow the stock market hit absolute all-time record
Yeah, it
highs.
was completely wild.
It was. The financial headlines were cheering, billionaires were doubling their net worth overnight, but then you walked into a grocery store and the price of a dozen eggs had literally doubled. It just feels like a rigged game where you're losing, even while the scoreboard on Wall Street says everyone is winning.
It is a disconnect that drives people completely crazy. And, well, the most important thing to realize here is that it's not a mistake.
Right.
It's not an accident or like a temporary glitch in the matrix. It is a mechanical, predictable feature of how modern money actually works.
Exactly. And that is our mission for today's deep dive. We are exploring a centuries-old economic secret that explains this exact phenomenon. But more importantly, we're going to reveal the ultimate playbook for protecting your wealth.
Which is so crucial right now.
Totally. We have a massive, really fascinating stack of documents to pull from today. We're anchoring this on an 18th century economic theory, then we're layering on modern frameworks from investing legends like Warren Buffett, and oh, this is the absolute wildest part. We are looking at a massive cross-model synthesis.
Yes, the AI
Yeah.
analysis.
4 different artificial intelligence models analyze the entire public stock market to find the ultimate mathematically pure, inflation-proof assets.
Our goal today is to help you separate the noise from the structural truth.
Hmm.
Because honestly, the reality of economics is that money printing is never ever neutral.
Never.
It always creates winners and it always creates losers. Our job today is to unpack the mechanics of that reality so you can make sure you end up on the winning side of that equation.
Okay, let's jump right in because before we can even talk about how to protect your money, we really have to understand how it is being, quietly diluted right out of your pocket.
Okay.
And to do that, our sources take us all the way back to an 18th century economist named Richard Cantillon.
Yeah, Cantillon is basically the master key to all of this. Back in the 1700s, he made this core discovery that fundamentally changes how you view the modern economy.
How so?
Well, most people assume that when a central bank expands the money supply, that new money just drops evenly from the sky like rain.
Like everyone gets a little wet at the same time.
Exactly. The assumption is that everyone gets wet, prices go up uniformly across the board, and purchasing power basically stays balanced. But Cantillon proved mathematically that it's just not what happens.
Wow.
Yeah, new money enters the economy at very specific injection points.
Okay, hold on. Let's unpack this. What exactly is an injection point in today's economy? Because, I mean, the Federal Reserve isn't just mailing checks to everybody every time they print money.
Right? They definitely are. Instead of rain, you really need to visualize the money supply like a massive, multi-tiered stone fountain.
Okay, a fountain.
The central bank pours newly created fiat money, which, by the way, is just money created by government decree backed by nothing but faith. They pour it directly into the very top tier of that fountain.
Right.
The initial recipients of this cash are what we call the early receivers. In our modern system, these are primary dealers.
And primary dealers are essentially the mega banks, right? The ones who are actually authorized to trade directly with the Federal Reserve.
Exactly. The mega banks, massive financial institutions, government entities. They sit right in that top basin of the fountain. When the Fed injects billions, these institutions get the water first.
Must be nice.
Oh, it is. And here is their massive structural advantage. They get to spend this new cash before local prices in the broader economy have had time to rise.
Ah,
They get what economists call an arbitrage advantage. They take these high purchasing power dollars and immediately buy up real-world assets, real estate, and equities at depressed pre-inflation prices.
I love this. And the sources sparked a slightly different analogy for me. It is exactly like a VIP buffet.
Oh, that's a good way to put it.
Right. Think about it this way. The insiders, these early receivers, get the velvet rope lifted for them before anyone else. They walk into the dining room first, and they get to pile their plates high with the absolute best food, all at yesterday's prices.
Yeah, they're just loading up.
They are loading up. But by the time the water trickles down the fountain or by the time the doors finally open to you, the late receiver, which is, your average wage earner, your retiree, the person on a fixed income, only the crumbs are left at the buffet.
Exactly.
And worse, because all that new money has now flooded the room, the price of admission to the buffet has doubled.
That VIP buffet is the perfect way to visualize the Cantillon effect. Because as those early receivers deploy their capital, demand surges in very specific sectors. First, mostly financial and capital markets.
Which is why the stock market goes crazy.
Yes. Equities inflate rapidly long before the cash filters down into the broader consumer economy. By the time that new money flows through the corporate structures and finally reaches you, the late receiver, in the form of like a 3% wage increase, the purchasing power of that money has already been destroyed.
That is so frustrating.
It really is. You are forced to pay 20% higher prices for everyday goods. So this inflation isn't just an annoyance. It acts as a non-legislated, completely hidden, regressive tax on your wealth. It literally transfers purchasing power from the bottom to the top.
And this isn't just some quirky historical observation from the 1700s either. The sources show this is the absolute operational bedrock of the Austrian business cycle theory.
Yes, the Austrian business cycle theory, or ABCT. The Austrians basically built on Cantillon to explain why we have these massive boom and bust cycles.
Right. Because this money printing isn't neutral, it produces a very distinct sequence. It starts with an artificial boom. Central banks lower interest rates below the natural market rate to stimulate the economy.
Okay.
So these early receivers borrow heavily to fund capital-intensive projects. The stock market and real estate rally on this flood of high liquidity. But this leads directly to phase two, which is the most dangerous part of malinvestment.
Okay. Unpack malinvestment for us, because that sounds like a dry textbook term, but it has massive real-world consequences.
Malinvestment happens because the newly printed money distorts the pricing signals in the market. Normally, low interest rates mean consumers are saving a lot of money, which signals to entrepreneurs, hey, there is real capital available to build long-term projects.
Right, it means the resources are actually there.
Exactly. But in this case, consumers aren't saving the central bank just printed paper. Entrepreneurs mistake this artificial credit for actual structural savings, so they engage in malinvestment.
They build things nobody actually needs. Yes, they pour billions into speculative assets or projects that aren't actually supported by real consumer demand. Think of the massive boom in profitless tech startups or ghost cities in real estate. The capital is misallocated because the compass is broken.
And what's fascinating is the structural footprint this leaves in the real world. The sources point out that if you want to know if this cycle is actively turning, all you have to do is look at the widening gap between financial asset appreciation and the consumer price index.
That is the ultimate tell.
Right. If the S&P 500 is soaring by 20%, but wages and real material growth are flatlining, you are standing right in the middle of a Cantillon injection. And eventually you hit a structural bottleneck, right?
Yeah, you absolutely do.
Because you cannot solve real material constraints like a shortage of copper, oil, or labor just by printing more paper.
Exactly. You hit the wall of reality. The new money finally filters down, consumer inflation spikes, and the cost of actual materials escalates. And then comes the bust.
The painful part.
Extremely painful. To stop the runaway consumer inflation, the central bank is forced to hike interest rates. Suddenly, the artificial liquidity floor drops out. Those speculative projects we talked about, they are exposed as fundamentally unviable because the cheap debt is gone.
So everything just collapses.
You get a massive liquidation phase, a crash, the cycle completes, wealth has been redistributed upward to the early receivers who sold at the top, and the late receivers are left holding the bag.
All right, so let's pivot to the practical side, because if you are listening to this right now, you are probably thinking, wow, I am definitely a late receiver stuck in this cycle.
Most of us are.
Yeah. So how do you actually play defense? If your cash is being actively debased in your bank account, what actually absorbs all that new liquidity? How do we build a Cantillon cycle hedge?
Where the core principle of a Cantillon hedge is incredibly specific, and it comes down to mechanics. You must own scarce assets that cannot be printed, and crucially, whose supply responds very slowly to capital inflows.
So things you can't just magically create more of.
Exactly. Historically, when credit is created, it flows into financial assets first, then real estate, then land and resource assets, before finally hitting consumer goods. Assets with a fixed supply absorb that liquidity the best because you can't just spin up a factory to make more of them.
The sources break this down into a really helpful hierarchy, starting with Tier 1, pure scarcity assets. We're talking about farmland, timberland, water rights, and mineral rights.
The best stuff.
Yeah, and the mental model the sources use here is brilliant. Own the dirt, not the tenant. You want the irreplaceable real-world collateral. Farmland gives you a fixed supply of food-producing land. Timberland gives you biological growth. The trees literally keep growing and adding volume regardless of whether the Federal Reserve is hiking or cutting rates.
The biological growth is a massive, totally uncorrelated advantage. And moving down the hierarchy, Tier 2 gives us resource monopolies.
Okay, what falls in that category?
These are businesses controlling a massive, scarce resource base. They benefit when resource values rise, but they carry a bit more risks than pure Tier 1 dirt because they are actually operating businesses with, employees and equipment.
Makes sense. And then Tier 3 is infrastructure with pricing power. Think toll roads, pipelines, electric transmission lines. I really love the mechanics of this.
It's super smart.
Their revenues are frequently contract-linked or regulated with inflation adjustments. When inflation hits and the cost of everything goes up, the toll on the highway automatically goes up. It's mathematically built into the system to capture the inflation rather than be a victim of it.
Right. But we have to address what everyone immediately thinks of when they hear inflation hedge.
Yeah.
If we jump down to Tier 5 in the sources, we find residential real estate.
Oh, yes. And the sources note it's historically one of the biggest beneficiaries of credit creation. It's highly financeable, it has a fixed supply in desirable locations, and if you have a 30-year fixed mortgage, that debt becomes way easier to repay as the currency depreciates.
Because you're paying back the bank with cheaper dollars.
Exactly. But the weakness is pretty glaring, isn't it?
It is incredibly sensitive to interest rates, which we just saw in the recent housing cycle. But more importantly, the physical structures themselves depreciate.
The actual house.
Right. The house rots, the roof leaks, the HVAC system breaks.
Yeah.
It takes constant capital injection just to maintain its baseline value.
Oh.
It's the land underneath the house that reliably appreciates because the land remains scarce. That goes right back to your mental model. Own the dirt, not the tenant, or in this case, not the shingles.
Exactly. Now, this is where I am not going to let the sources off the hook, and I really need you to explain this to me.
Okay, hit me.
If we look at Tier 6, all the way at the absolute bottom of this hierarchy, it's gold. Isn't gold the ultimate historic inflation hedge? I mean, for thousands of years, gold has been the standard. Why on earth is it ranked so low compared to a toll road or an acre of farmland?
It is a great question, but to understand it, we have to look through what the sources call the Warren Buffett and Charlie Munger view.
Okay, the investing legends.
Right. Mechanically, gold is an inert store of value. It sits in a dark vault. It doesn't produce anything. It doesn't birth little baby gold coins. It doesn't pay a dividend.
Hold on, I hear the Buffett argument that it doesn't produce a dividend. But wait, if gold is just an inert, shiny rock, why are central banks all over the world currently buying it at record levels?
That's a fair point.
If it's useless and unproductive, why do the money printers themselves hoard it in their vault?
That is the perfect distinction to make. Central banks buy gold because it is a sovereign reserve asset. It is a bearer instrument with no counterparty risk.
So it's safe.
Very safe. If the global financial system freezes, or if a country gets sanctioned, gold is the ultimate geopolitical insurance policy. It guarantees a nation's solvency in a crisis. But you are not a sovereign nation.
Last time I checked, no.
Right. You are a retail investor trying to compound your purchasing power over a 30-year retirement horizon. For you, gold is just a crisis hedge. It protects you from absolute disaster, but it does not compound.
Ah, okay. That clarifies it immensely. A sovereign nation needs a crisis anchor. I need a compounding machine.
Exactly. The smartest allocators prefer productive assets that generate cash flow. A toll road or a timber forest produces real tangible value regardless of the currency's strength. You are getting paid while also holding a scarce asset. Over very long periods, productive land absolutely crushes gold in terms of total return.
Okay, so conceptually, we know we should buy water and land. But I can hear the listener's internal monologue right now. That's great for billionaires, but I can't just go out and buy a toll road in Ohio, and I definitely don't have $50 million to buy a timber forest.
Most people don't.
Right. So how do everyday investors actually access this Tier 1 scarcity without needing massive private equity capital?
And that is the exact bridge from economic theory to actual public market execution.
Yeah.
How do you buy this in your standard brokerage account?
Here's where it gets really interesting. The sources detail this massive all-tab synthesis. They ran this problem through 4 independent artificial intelligence models: Perplexity, Claude, Gemini, and Grok.
Which is such a cool approach.
It's amazing. They had the AI analyze the entire stock market across different axes. They looked at moat purity, like how hard is it for a competitor to break into the business. They looked at business durability and intrinsic valuation clarity, which just means how easy is it to actually predict their future cash flows.
And what's fascinating is the friction between the models. Because they all have different training weights, they approach the problem differently.
How so?
Grok, for instance, leaned heavily into pure decentralization and raw commodities. Claude, on the other hand, prioritized traditional balance sheet strength and cash flow stability. But the goal of the synthesis was to find the cross-model invariant. Where did all 4 entirely different models overlap perfectly?
And when you collapse all that data, the AI revealed 2 very distinct hierarchies. The first is the structural hierarchy. This is purely about Cantillon purity. How close is this asset to being raw, unprintable scarcity collateral?
Yep.
The second is the investor quality hierarchy. This evaluates the actual corporate wrapper, the business quality, the management, and the compounding ability.
And the friction between those 2 hierarchies is the most valuable insight for an investor. It highlights the vast difference between a great asset and a great business wrapper.
Yes. For example, every single AI model agreed that farmland is an incredible asset. It's basically the perfect Cantillon hedge. But if you want to buy it in the public markets, you have to buy REITs, real estate investment trusts like FPI or land.
And the AI didn't like those.
Universally flag them as structurally weak vehicles. Why? Because while the dirt is great, the corporate wrapper is leaking money. You suffer from massive corporate overhead paying executive salaries, you take on extreme weather and crop volatility, and you have tenant risk if the farmers default.
Wow.
You might own the dirt, but the vehicle you used to buy it is flawed.
Which raises an incredibly important question for you as the investor. What do you actually want to own? Do you want the absolute purest scarcity hedge? Or do you want the best compounding business? Because as the public market data shows, they are almost never the same thing.
So let's merge the 2 hierarchies. If you want to build an allocator-grade portfolio that survives every single AI lens, the Cantillon purity test and the Buffett business quality test, what are the exact public market winners?
Let's start with the purest scarcity collateral. If you want pure Cantillon defense, the undisputed consensus winners across every model were royalty trusts. Specifically, energy and mineral trusts with tickers like DMLP, SBR, and CRT.
Let's break down the mechanics of a royalty trust because it completely blew my mind. These entities have 0 employees, 0 capital expenditures, 0 debt. How is that even a public company?
It is brilliant, isn't it? They aren't traditional companies. They are financial pass-through vehicles. They simply own the mineral rights to a piece of land, and they lease it to an operator who does all the expensive drilling and pumping.
So they just sit back.
Basically, yeah. The trust just collects a royalty percentage off the top of whatever's pulled out of the ground.
So mathematically, 0 employees and 0 capex means when inflation drives the cost of labor and heavy machinery through the roof, your expenses do not change because you literally don't have any.
Exactly.
You just collect a larger check as the price of the commodity goes up. It is the closest thing you can buy in the public markets to pure Cantillon collateral.
Okay, so if royalty trusts are the ultimate raw asset, what if you do want a functioning business, but one that operates like a Cantillon monopoly? What was the best business category?
The consensus winner for the highest quality business wrapper was water utilities, specifically American Water Works, ticker AWK. Every model loved this.
Oh, water.
Yeah, they have regulated monopoly moats and totally inelastic demand because obviously humans cannot stop buying water during a recession.
Right. But explain how their cash flow works, because as a utility, aren't their prices capped by the government? How does that protect against inflation? They use what are called rate case cash flows. Because water is a public necessity, these companies agree to price caps. But in exchange, the government regulators practically guarantee them a set return on their equity.
Oh, wow.
Yeah, so when inflation drives up the cost of purifying and delivering water, AWK just files a formal rate case with the state regulator, proving their costs went up. The regulator then approves a price hike on the consumer to restore the company's guaranteed profit margin.
That's incredible.
It is a completely legalized, guaranteed toll bridge where the inflation is mathematically passed on to the late receiver.
Water perfectly overlaps pure physical scarcity with an impenetrable business moat. And finally, what was the winner for the best real asset compounder.
That goes to the timberland REITs, specifically Weyerhaeuser, ticker WYY. This gives you the biological compounding we talked about earlier.
The growing trees.
Right. Unlike a gold bar sitting in a vault, a pine forest is actively growing larger and more variable every single day, completely independent of the economy. Plus, Weyerhaeuser owns millions of acres of land, giving you massive physical scarcity.
So to summarize this grand AI synthesis, you buy American Waterworks for unparalleled business quality and monopoly rate case power. You buy Weyerhaeuser for real asset biological compounding.
Oh.
And you buy a trust like DMLP for pure zero-expense Cantillon inflation protection.
A perfect trio.
And as all 4 AI models noted, almost everything else in the public markets, it's just noise.
If we pull back and connect this to the bigger picture, these specific assets work so well because they form an impenetrable wall against the malinvestment of the Austrian business cycle.
Right.
When the central bank distorts the market with cheap paper and everyone else is speculating on profitless tech startups or overvalued consumer goods, you are holding the fundamental inputs of human survival and commerce. You are effectively front-running the central bank by owning the base layer of physical reality.
So what does this all mean for you? Let's recap this journey. We started by noticing that newly printed money does not help everyone equally. It is a sequence.
An unfair sequence.
Exactly. It actively steals purchasing power from the late receivers, the everyday consumer. And it rewards the early receivers, the banks and mega institutions. It's the Cantillon effect in action, driving a massive wedge between stock prices and your grocery bill.
Yeah.
And the only way to opt out of this hidden regressive tax is to park your wealth in scarce, productive assets. You have to own the dirt, the water, the biological growth, and the monopolies that simply cannot be diluted by a government printing press.
And that mechanical reality leaves us with a final, deeply provocative thought to consider.
Oh, I like where this is going.
Well, this entire centuries-old cycle we've explored today, the artificial booms, the devastating busts, the early receivers gaming the system, and the absolute necessity for investors to build these elaborate resource hedges, it is entirely driven by one thing: the continuous expansion of fiat currency orchestrated by central banks.
The printing press.
Exactly. But what if the rules of money were to change? What if the world were to eventually adopt a truly decentralized digital currency with an absolute mathematically fixed supply like Bitcoin?
Wait, that completely breaks the Cantillon model, because if the ledger is decentralized and fixed, there is no central injection point anymore. The multi-tiered fountain disappeared.
Exactly. If there is absolutely no way to print more money, the Cantillon effect vanishes entirely. And if it does, what happens to the massive premium on all these perfect inflation hedges we just talked about?
Mind blown.
If money can no longer be debased, does farmland go back to just being priced on its crop yield rather than its scarcity premium?
That is an incredibly deep question. If the rules of base money permanently change, the rules of the entire investment playbook have to change too. Highly encourage you to ponder that scenario, because a shift to a fixed supply ledger might just be the next great economic earthquake. Until then, thank you for joining us on this deep dive. Stay curious, keep looking for the structural truth beneath the financial noise, and we will catch you on the next one.